So in the last video, we looked at order blocks and fair value gaps and how to take entries from those points of internal range liquidity towards high probability targets in the market. What happens when you're wrong and price just trades straight through the order block in the opposing direction? Well, that can become a flip zone or a breaker block, and that can actually be your next entry. So let's take a look at exactly what a breaker block is and how to think of it in terms of internal range liquidity. So a breaker block is an order block that was closed through in the opposing direction. I also like to call it a flip zone. So instead of holding price trades through and flips the original order block. So breaker block or flip zone. What was support becomes resistance. What was resistance becomes support. So this is what a breaker block looks like visualized. So you've got this down movement in the market, sell pressure, you get buy pressure followed by sell pressure, order block creation. So this is a bearish order block. It's the last buy before the sell. So what we're expecting at this point, as long as we're in line with higher time frame context, is for price to come into the order block and then continue lower. But instead, price trades aggressively through the old order block. So what was the bearish order block turns into a breaker block or flip zone. And yes, you can look at internal range liquidity in these legs, but it doesn't always line up so perfectly. And you do get these breaker blocks that sit in the market that get respected, and we can use them to take trades. So what to look for? Failed order blocks that price traded through aggressively. Breakers contained inside valid price legs. New direction starting. Breakers aligned with higher time frame candle direction. When I say breaker, I mean breaker block. So breaker block, flip zone, breaker, they're all interchangeable. So with that, let's take a quick look at an example that played out in CADJPY, the example we've been running through in the whole of this series. So we've already touched on this entry, and this is clearly a fair value gap entry. But we spoke about at the start of the series this downtrend. So what price does is it comes in to the high, first and foremost. See, when this new candle range opens, and actually just to say, we are trading 12-hour price action, swing trading, monthly, 2-weekly, and weekly trade ideas. So we're starting with our monthly context right here. So this entire range of price action is the monthly range. Price opens and immediately stings into the high of the previous candle range. So we potentially may start to see a reversal at this stage. If we remove the 1 month time frame and look at the 2-week time frame, what we also see is this is a previous 2-week candle range as well. So price was moving aggressively up. We came down into support and then aggressively moved into the high of this 2-week candle. What happens next is we get an aggressive shift. So price just moves essentially straight through the fair value gap and the order block and closes. At the same time, we close this 2-week candles range. So now we have a clear draw in the market. We have an accumulation candle. We then have a manipulation candle close inside. So the next target for price is the low of the 2-week accumulation candle. The monthly is also in favor because we've liquidated the high. So what happens next? Price trades through. We get the formation of an order block, the last buy before the sell, right here. So we can mark that as our order block. We also get the creation of a huge bearish fair value gap, which is the creation of the inefficiency between candle 1 and candle 3. I can zoom in a bit there. You see candle 1, candle 3, imbalance in price because there's so much volume moving bearish in the market. Now, if we're looking to get, we have our context. We have a liquidation, a higher time frame target. So how do we get involved in this trade and make it profitable? So if we take the order block it's quite far away. Price needs to retrace very far to get tagged in. So that is, it could play off, it could play out, but it's a long time to wait and potentially you're going to miss the move. If we take the fair value gap, we are likely going to get traded, or we're going to get tagged into the trade. But where do we put our stop loss? If we put it up here or behind the swing point, even to the target, you can see it's more of a position trade really. So what we can do is look for other points of internal range liquidity. So we can keep these on our chart. What we see is this was the old order block right here. So originally this was the last sell before the buy. So when price trades back through, we can drag this across and this becomes internal range liquidity in this price leg that price may want to respect. And I like to actually mark this in a different color so that we can see it clearly. So this is the last order block in this bullish move, which then becomes the resistance to take us to our target. So you can then start to stack confluence entries whereby you say, I want to get involved at the fair value gap, but instead of covering the swing point, I'm going to cover the breaker block. And then if you take the trade to its target, you've got a 3.24R. Alternatively, you can just be a bit more cautious and maybe cover this entire range and you've got a 2R. So you see the last two sell candles. So you can be creative with this, but if you just take the breaker block and you take this as pure, practical application, you have a very high probability swing trade to a high probability target. Of course, we never know if we're going to get stopped out here, but if you just play it from the breaker block, you've got a great swing trade. And that's how to basically turn order blocks, failed order blocks, into points of internal range liquidity in your price legs to take high probability, high RR trades that make practical sense. So in the next video, we're now going to look at premium and discount zones within our price legs.